Welcome to the Business Happy Hour radio show with your host, Frank the Bank Cotto, president of Lincoln Lending Group and 813 Mortgage for 20 years right here in Tampa Bay. Joined by his incredible co-hosts, Rosa Vahidi and Senia Akishina, top producing real estate agents with Mahara and Associates. These three bring nearly 5 decades of experience in the local real estate market. If you're looking for real estate or business advice, no matter what your experience level, the Business Happy Hour team has been there for you for almost a decade right here on News Radio WFLA. Now sit back, relax, and get ready for some serious real estate and business talk with 3 of Tampa Bay's top experts. Here's Frank the Bank.
Hey, Tampa Bay, welcome back to the #1 show for all things business and entrepreneurial right here on WFLA. iHeartRadio, baby. That's right. The Real Business Happy Hour. Thank you, James. Thank you for all the applause. I'm in studio with my amazing co-host, Senia Akishina. How you doing, Senia?
Hello, everybody. Hello, Frank.
All right. Good to see you today. How's your week going?
Going pretty good. No complaints here. Loving this weather, I got to tell you.
Oh, my God. It is so amazing out there right now, isn't it? And so if you guys are watching us live on Instagram, you know that the weather is probably about 80 degrees right now. But if you are listening on Sunday morning, it's pretty chilly out there, I do believe. Is that your volume or mine that I'm killing it? Sorry, we're having a little Instagram fun here today. Guys, we have a great show for you. We are very happy to have our guests in studio. I can't remember the last time that have we had a lender on, like a lender, account exec, or a manager or anything?
So.
I don't think we have. This might be one of the first times. 10 years on this show. I don't know if we've ever done this before, but I have the pleasure to introduce Kyle and Jay Goldberg from LendSure Mortgage Company. They are actually a lender. They are one of the lenders that we at Lincoln Lending Group send our business to. And what I was so impressed because Jay and Kyle came in and did a presentation for my entire team last Thursday and bought everybody lunch. Thank you very much for that, by the way, guys. A little Mission Barbecue over there. And Jay did a presentation. I'm just going to call it about common sense lending. And I think that word common sense is just not used enough in lending these days. Mainly because back in the day, I'm going to throw back like grandparents' days here. Our grandparents, used to go to the bank and say, Mr. Banker, it's Jim down here at the farm, and I need a new tractor, and we're going to pull some wheat this year, and everything's going to be good. I just need you to give me about $100,000, and I'm good for it. And they'd shake their hand and look them in the eyes, and everything was good. And that was common sense, right? And then we get into this whole banking world and in the 70s and the 80s and savings and loans and lending, and common sense just went away. That personal touch in banking went away. There's no such thing as telling your banker you trust to trust you anymore. Matter of fact, people will call me sometimes, and you can always tell like how old they are. They're like, listen, I just want to come in and meet with you. I want to talk to you about my situation. And I have to tell them, I'm like, listen, it's not like that anymore. It doesn't matter how much I like you or if I care or how pretty you are or anything. That's just not how banking is until now. Until Jay comes in and decides to do this presentation in front of my team last week and essentially tells us all these things about how they can look at transactions and they can figure things out. Now, they're not going to shake the farmer's hand and tell him you trust them. Although you did tell me a good story, Jay, about trusting somebody at a very low loan to value and a very big loan amount because it's all about risk. But we're going to get to that in a minute. Go ahead and say hi, guys, Jay and Kyle.
How's everyone doing today?
That's Kyle.
And this is Jay. I'm really glad to be here and bringing some new insight to the lending that most people don't realize is available out there.
That's right. And I'll turn around the camera a little bit when you're talking, Jay, and I'll make sure I get you on there. But before we do that, Senia and I have one of our favorite parts of the show, every show, is we like to do statistics. And if you don't know Senia Akishina, she is with Mahara and Associates, one of the faster growing, that's right, applause, one of the faster growing real estate companies. You guys have over 100 agents here local in Tampa Bay. I haven't asked you in a while. Do you know how your year is going to end up? We used to do that all the time, saying the kind of like how many transactions Mahara and Associates has closed. Am I putting you on the spot?
We did know it. I knew that. I'm like, I don't want to mess it up. I feel like we are.
Welcome to the show. Landon.
Like 340 million, maybe.
My gosh, not bad. Not bad.
Pending and closed, I think.
That's a lot. Do you know what the number of transactions? I'm really putting you on the spot today.
I don't know the number of transactions. I will have to ask our girl Stephanie at the office.
All right, next week we're going to know the number of transactions. And actually, you know what I'm going to do is I'm going to pull up some stats. So I'll do some homework, and I'll pull up the number of transactions Lincoln Lending closed, and we'll look at Mahara and Lincoln Lending and some dollar amounts because we run in very similar numbers with each other. You guys have a great team. If they do need to get in touch with you about real estate, what's the best way for them to do that?
I think they should call me at 813-755-REAL, or you can go online at therealdealtampa.com.
That's it, therealdealtampa.com. Very easy for you guys to remember. Check them out. And that you want to call Senia when you have a house you want to buy, or maybe you're interested in looking at some properties, right? Is that the best time?
Yes, or if you want to sell. We still need that inventory, so we need those sellers to get their house on the market.
That's right. Well, so let's talk about the statistics. What are you surprising us with today?
Well, so we do have our October numbers. So we discussed that, last week that new pending sales were down. So we'll see how November ends up in terms of closed sales. Because overall, activity has slowed down.
Right. We slowed down, but there's still excitement out there. And
there's
the buyers
excitement. And I do think that just the fact that our prices are still steady. Right. When you see the little bit of decline, it's just a little bit of a decline. It's the market correcting itself. And, we're in December now, so we really do think that next year things are going to, start waking up.
I think next year this whole country's going to wake up. And I don't know, Kyle, you're laughing. What do you think?
I think it's a true statement. I think a lot of people right now are they're struggling for Christmas gifts and stuff. The liquid cash isn't there. So I think with the new year coming around, new presidential election, coming in, I think it's going to be a very positive outlook. Next year it's going to be like a little bit of a ramp up, but I think in the coming years, the market's going to come back to kind of where the 2021 era was, where everyone was just firing off left and right.
Man, I love this guy.
Great prediction.
And that is a super, super exciting prediction. If you guys missed that on Instagram, Kyle is predicting 2025 is going to be another 2021, and people are going to be firing off.
Well, if that happens, buyers, you better get off that fence and start looking now.
Thank you, Senia. I think is this not the best time to buy?
I think it is. Absolutely. We're getting some great deals. I just have a fantastic deal on a new contract.
Nice.
We got about more than 40,000 off the list price.
What?
So when people see that, it's like, hey, sellers are negotiating.
Yes, they are. But as soon as what Kyle said happens, no more negotiations. Because now when these buyers come back, that's what people have to understand. It's supply and demand. If the buyers are back and you don't have the big inventory, it's going to be multiple offers on these properties.
And we still don't have the inventory. That is like one of the stats.
Let's do that
little
one.
sheet between all of them. Like in Hillsborough County, we dipped just a little bit.
Okay.
So for October, our month supply is 3.3 in Hillsborough County.
Where were we? When we were little, weren't we like 3.5 or 3.6?
It was like 3.4.
Oh,
but still, if the equilibrium to consider, even playing field, like we're not there.
Right. No, we're not, because you got to be at 6, right? That's your equilibrium, 6 months?
You do. So yeah, like what this number means is if no other homes, got listed, then it would take 3.3 months to sell the existing inventory.
Yeah. How low have you ever seen it? I'm curious.
In 21, 22, inventory was almost like non-existent, like numbers were, 2 months, I think probably lower than that.
So that's why we had that huge, highest and best and the multiple offers, just simply because there were not enough homes to buy.
Yeah. So to put it in perspective, year over year, our inventory is up 40%.
Oh, really?
But still that number, like we have, a lot more inventory to go for, there really to be more options for buyers.
Right.
And I'm hoping that that'll happen come next year.
Right. But until then, now, Jay, go ahead. Yeah. I know you got something to say.
Well, with what we're saying about inventories being increased and some market pressure in the make sense lending arena right now, we're actually breaking month over month records.
Really?
Last month, which you would have thought with Thanksgiving and a shorter month, I think it was only an 18-day business day month.
Right.
We broke records both on the West Coast and the East Coast and exceeded all of our goals. So there is robust lending out there when you find the opportunity to find the right lenders,
Right.
and the right products that fit your needs.
So we're going to dive into this with Jay and Kyle from LendSure and talk about this common sense lending, and he's talking about a whole different type of lending, guys. The reason we have him on today, and I think Senia, we're going to both learn a lot today. This is not about FHA, VA, and conventional loans. This is about the loans when you can't qualify for those, and it is becoming a huge segment of lending and of real estate. If you would ask somebody 5 years ago about non-QM lending and what percentage it was, matter of fact, Jay, you might have that stat. I'll put you on the spot. Is what percentage is non-QM lending in the entire space? Do you know that by chance?
The current numbers I don't have, but coming out of COVID and with the growth of alternative lending or non-QM lending,
Right.
it was projected to be the highest growing business entity in the United States at that time. Some things have slowed down with price increases, some of the insurance problems that we're dealing with, but it's still a very robust market. There was a lot of people that never realized that there was lending options for them post the subprime crash back in 2008 and 2009, where non-QM, which is not a subprime product, it has brought alternative lending back into the space about 6 or 7 years ago, and now it's really getting its legs under, and a lot of the general population is starting to figure out that there are opportunities out there.
Yeah. So when we get back from the break here in a minute, after we do some more stats with Senia and I, we're going to learn what the heck is non-QM lending, because a lot of you guys are out there.
I was going to say, yes, you probably need to tell everybody because that is a term we're hearing more of. But I mean, yeah,
Senia's
5
like
years
raising her
ago.
hand. She's like, what's non-QM lending? No, you know what it is. But I'm going to let you ask Jay that question when we get back from the break. Tell you what we're going to do. We're going to take a break here. When we get back, we're going to talk a little bit more about the stats in the current market, so all of you know where you are, and we're going to explain to you why you should be marrying the house and date the rate, or date the program as well. We're going to talk to Jay and Kyle about that here from LendSure. And don't forget, if you need a mortgage, it is Lincoln Lending Group, 813mortgage.com, or contact frankthebank.com, or therealdealtampa.com if you need to find a home. And don't worry if you don't remember both of them, just ask for one and we'll get you to the other. We'll see you in a minute here on the Business Happy Hour. What did you guys think about your first radio segment?
That was good.
That seemed like it worked.
And listen, don't like if you got something to say it. And if Cindy and I are in a rant and we're talking about something or whatever, and something pops up so you don't forget about it, throw your hand. Like, just be like, boom, and I'll be like, Jay, what do you got? You got something on that? Kyle, what do you got? Very fluid. You know what I mean? And like I said outside in the lobby, you don't have to agree with us, right? So if you when we get back and after we do our stats, one of the things, I want to, you gave an answer. I want to ask you, what do you think about the market just in general, right? And then, Senia, you go in and you can ask, what the heck is non-QM lending? And then we'll learn what that is, and then we'll figure out how you make money with it. I looked up a stat. It said it's only 5%, but I think that is no way it is only 5% of lending. It's got to be way.
Now we're back with some serious real estate and business talk with three of Tampa Bay's top experts. Your host of the Business Happy Hour, Frank the Bank Cotto, Rosa Fahidi, and Senia Akishna.
All right, Tampa Bay, welcome back to the Business Happy Hour, your number one show for all things business and entrepreneurial. We have a couple great guests today. We have some great statistics. We have some good news for you. So if you're looking for good news early in the morning on Sunday or right here on Instagram, you have come to the right place, the Business Happy Hour. If you need to find a realtor, if you actually want to find a house and you can actually close before the end of the year, believe it or not, if you act now, we can guarantee that you will close by the end of the year. I can tell you that right now. And you can get your homestead exemption for this year. You got to go to therealdealtampa.com, talk to Senia, let her find you a house, and then you go over to my website, 813mortgage.com, click on my little picture, and we will find you the financing that you're going to need. And guess what? If we can't find conventional or government financing for you, today you're going to learn about a whole new segment of lending called non-QM lending, but I'm going to call it common sense lending today. We're going to bring back Jim going to the banker, asking for a farm loan for the tractor. We're bringing it back, guys. Get ready to shake the hand and get a loan from LendSure here in just a minute. But before that, my favorite part of the show, the stats. Senia, take it away.
Okay, so I guess where we can finish up at, I did come across a Realtor.com article.
Ooh.
And it is saying that existing home sales are going to soar next year.
Really?
And we've got 3 Florida cities on their list of 20.
Come on, Tampa. Come on, Tampa.
Come on. Well, Tampa is not up, but I mean, it's got to be in the mix. No, because
Okay.
Orlando's there, Jacksonville, Miami. So
I
you know
mean,
that Tampa's right there.
Come on.
So
45
I
minutes.
think that's exciting. I mean, they're, digit.
What are they
increases.
predicting? This is exciting.
Well, Jacksonville is at the bottom there, but 13% increase year over year.
in sale prices or
And just in home sales.
wow.
So
okay.
we've been talking about how, it's been a little bit slower. Home sales are generally down. But I think this just goes along with what we're all thinking is, hey, next year things are going to start picking up the pace.
Did you have the Orlando one? What it says about that one? They're the closest.
Orlando's 15.2%.
Woohoo!
And then Miami is actually number 2 on the list at 24%.
What? They're talking about a 24% increase in home sales in Miami? Mm-hmm. That's crazy. What do you think, Kyle?
That's going to be hard with the condo market, with all the new laws coming into place and stuff. I mean, I know a lot of people, younger generation and stuff like that, they all move to Miami because it's the new hype and stuff like that. Then they get down there, they have no yards. Party scene's too much for them after, year 1, year 2.
Yeah.
And then they're moving back to Pennsylvania because they're over it. So I don't know about Miami. Miami definitely, I'd be intrigued to see if, it is one of the top, areas.
Yeah. Downtown St. Pete. I'm really, I like the Dunedin, the downtown St. Pete's, things like that. Somebody yesterday really brought up a question about condos and should they be buying a condo right now or not. I feel, Sen, you chime in on this.
Well, the one thing so when we do stats, I only really include single family homes.
I was going to ask you.
I went ahead and today I'm like, what? Let me just grab it just in case, because I mean, we've definitely seen, the condo, and they group them in condos and townhomes.
Yeah.
That market, definitely been struggling just because of, all the inspections, the new rules, milestone surveys. So those numbers have definitely dropped a bit.
Okay.
It's more challenging to sell them. They're on the market longer.
He's got these assessments and the association fees going up. And so how bad is it?
Well, let's see. Where's my sheet here?
What are you saying, Jay?
Let me jump in one second.
Yeah, jump in while she's looking.
The condo market does have pressure on it right now, but there's a very good, robust side to the condo market. As long as you do your homework, or the people that you're working with do your homework, as long as the condo that you're looking at is either a newer condo or it has gone through the cycle with the new laws, you know what you're dealing with. Where the problem comes in is when you don't know, and there could be some surprises out there. So it really comes down to educating yourself on the building that you are looking at to see if it's the right building for you.
So let me
yes.
ask you this before Sen gets her stats on it. I said something to somebody the other day. I hope I said it right, but these laws all go into effect by January 1st, but they've all known about it. So it's like they have to implement all of this reserve stuff and everything by the 1st, which means for the 2025 budgets. Am I right or wrong? Shouldn't most condos already have it figured out?
Well, you would like to think that would be true, but
right.
It seems like a majority of them has really kicked the can down the road. They might have gotten involved in some of the new structures that they need, but they haven't gotten all the way through. One of the big holdbacks, and there are going to be some changes in the upcoming legislature session, is all the condos that are more than 30 years old need to have a full structural inspection on it.
Engineering report, yep.
Just is not enough engineers out there. I'm hearing some stats, and this might not be 100% factual, but some of the requests are going all the way out to 2027 right now.
God.
And they're required by December 31st of this month.
Oh, man.
So Governor DeSantis, he wanted to bring in a special session because of this, and none of the legislature would come. So it is the first thing on the docket for this year's legislature session to be able to modify some of these condo laws or extend them so the condos can comply.
That's a very good point. Well, I'm sure you got to think these hurricanes had to set the guys back as well. I mean, it probably didn't help, but
well, they had since 2021.
Yeah,
I mean, October wasn't really going to be the determining factor of whether you're going to make it or not.
I was trying to cut him some slack over here. Jay's pretty tough on these guys. He's like, hey, listen, bro, you had 3 years. So I love your advice, though, Jay, and I think Cindy and I would agree, right, is it's more about the research, and I think it's more important now than ever on both the mortgage and the real estate side. Like I'm gonna put you on the spot. Don't kill me. But when you take a condo listing, What do you do as a listing agent? Do you research these things and get in with the HOA and find out?
Absolutely. Yeah. I mean, hey, did you guys have this done? Did you have that done?
Yeah.
But as Jay said, it's the newer buildings that already, are in compliance and things like that. I mean, those are good buys. And I do think that is the right property for some people. They don't want to have a yard to maintain. You pay your fee, but that covers everything. You just have maintenance-free living. So there's definitely good situations out there. But like I ended up selling our condo, which was kind of just a place we'd get away to in St. Pete last summer in 23.
Mm-hmm.
And I mean, I'm glad we did it. I could see that the sales in there are struggling, but they were older.
Right.
They were older. The assessments keep going up because there are things that have to be done. The balconies had to be redone, the seawalls. I mean, and those things rack up. And I think a big portion of it is those HOA fees or the condo fees.
Your seawall probably got demoed in October.
What really happened was if you look at a condo and compare it to a single family house, if you do not maintain your house and just maybe throw a little bit of paint on it from time to time, but not fix the pipe and just if you didn't do any work on your house in 40 years, what would your house look like?
Right.
And that's what's going on with the condos, that it's time to pay the piper for not doing what should have been done the whole time, and now it's all just coming to a head.
Exactly. We're going to take a break real quick. Sorry to cut you off, Jay. We got 8 seconds left. As soon as we get back, we'll learn a little more about condos and then common sense lending. Stay tuned. All right. Sorry about that. Okay, so, and you guys know, if I go like this, it means we got 1 minute. And then you were in something, so I didn't say anything to you. I was just going to see if you naturally ended or not. I got down to 8 seconds. I was like, okay, I got to shut him up. So what I'll do is if you guys are in the middle of a thought, we got 2 more segments, right? If it gets to a minute, I'll throw you the minute. Just try to wrap your thought up within 30 seconds. If I get to 30, wrap it up within 10, right? And it doesn't mean you have to end it. You can just be like, hey, Frank, I know we got to take a break. I'll finish it up when we get back, and then I'll take us out of the segment. So that was great on condos. I think that was a good touch. Now you guys also can kill it on condo stuff as well. So I think we need to wrap in the positive to this. Did we want to finish anything on the stats on that? Or do you feel good?
I feel good.
Okay. So we'll come back and I'll make one quick comment about condos to try to keep the positive vibe going on condos. And then why don't you just jump in and be like, all right, Frank, we're talking common sense lending. What the heck is non-QM? You guys keep saying it. And let him do that briefly. And then I'll kind of give you like a re-intro and be like, all right, common sense lending. This is what I want to really learn about. Tell me about LendSure. Tell me about this stuff. We've got about 11 minutes and then about 7 minutes.
Welcome to the Business Happy Hour radio show with your host, Frank the Bank Cotto, president of Lincoln Lending Group and 813 Mortgage for 20 years right here in Tampa Bay. Joined by his incredible co-hosts, Rosa Vahidi and Senia Akishina, top producing real estate agents with Mahara and Associates. These 3 bring nearly 5 decades of experience in the local real estate market. If you're looking for real estate or business advice, no matter what your experience level, the Business Happy Hour team has been there for you for almost a decade right here on News Radio WFLA. Now sit back, relax, and get ready for some serious real estate and business talk with 3 of Tampa Bay's top experts. Here's Frank the Bank.
All right, Tampa Bay, we're having a great show today. Cindy and I are learning some stuff, and I promise you guys are going to learn some stuff too. Good news is home sales are still looking good. There's some great news happening with condos if it's newer, according to Cindy. It's got to be a little newer, or they have to get their work done. I'm going to leave you with this on condos, and then we're going to get into common sense lending. Okay, this could be a great show. I just had somebody under contract on a condo, and they disclosed the HOA fee at $725. Turns out a week before closing, we get all the stuff back from the HOA. It's the reason I asked you what research you do, and I know you do all the research. So does everybody at Mahar and Associates. By the way, RealDealTampa.com. That's how you find them, RealDealTampa.com. Shameless plug. It was actually $1,050.
Oh my gosh.
And we all know from the condo world, when you have your HOA increase that much, you get notified. It doesn't happen on a Monday and they tell you on a Tuesday, right? No, or like a month, 2 months later. You find out the next day. Like your HOA is required to give you notification, like 90 days. Long story short, the poor buyer had to back out of the contract because there's over a 30% increase in the HOA fees. So great advice is do your research. There are a bunch of good condos out there. But we are going to learn about some creative condo options and some common sense condo options here with Jay and Kyle from LendSure in just a second. Cindy, you had a question.
Well, you call it common sense lending, and we've been hearing the term non-QM. Can you explain exactly what it is? What kind of products are non-QM loans?
Well, non-QM just essentially stands for non-qualified mortgage. A qualified mortgage is an agency or government-backed lending, FHA, Fannie, Freddie. So non-QM just means non-qualified under the standard qualifications. So to expand into that, a lot of it, when you're talking about an owner-occupied or a second home, which is regulated under the regulations post the crash in 2008, is that a borrower has to be able to income qualify and afford the property. In standard qualified mortgages, you've got very limited sources, a couple years of tax returns, or very stable W-2 or wage earner income, where in our arena, we've got approximately 15 different types of qualifications from income sources, where we'll go down to 1 year of income docs. We qualify a lot of self-employed people, which when you talk to a realtor about being self-employed, you usually get kind of a negative face back at you because of how the tax returns are going to look, where we'll actually just look at the businesses or the personal bank statements and qualify you on those, which meets regulations. We'll use multiple businesses and bring businesses together with bank statements. We'll do loans based on assets that you do have high holdings in public investment accounts or even restricted investment accounts, 401ks and things like that, that we can bring those assets into your loan and turn that into actual income, qualifying income. We do 1099 only loans where in self-employed people, one of the benefits of being self-employed is the ability to write off a lot of your expenses. And there might be additional usable income behind that. That's really a CPA question, but we create tangible income to qualify people that will fall out of the qualified mortgage arena. We do a lot of very creative ideas around the qualification of income. Like I said, there's at least 15 sources before we get into hybrid sources or merged sources, where I'll actually take somebody that's a standard wage earner, good job, let's say a teacher that's been on the job for 25 years, making $50,000, $60,000 a year, but has an astronomically large 401k package, that I will use that restricted investment as a income qualifier enhancement to their monthly income to qualify them for that property. The general idea here is that in the event that they did struggle financially, they've got the assets behind them to prevent a default. And that's the main thing, is to prevent default.
So that's the common sense nature of this lending, and kind of put it in layman's terms. I know, Sen, you're probably sitting here thinking, how come everybody doesn't do this? It's, you have somebody that cannot meet the guidelines of FHA, VA, or conventional loans because they're very strict. Give me your W-2s, give me your pay stubs, give me your tax returns. They don't play around with the bank statements and just 1099s and just assets and things like that. But you're saying you can take a common sense approach and you can look at what they have and formulate a plan. Am I understanding that?
Yeah, like I'll give you a perfect example, especially coming out of COVID, where a lot of businesses ceased to operate for a period of time or had a downturn in their revenue.
Right.
Where they might not qualify using 2 years of income docs because of the reduction, but they do qualify on 1 year income docs. So we'll eliminate that downturn year or the declining income if they still qualify. If you're looking at a business that has less revenue this year than last year, that would be a negative when you're doing an income calculation. Well, if they do qualify on the current income, we'll eliminate the year prior that is the problem in the agency world, because you are going to pay your payment on the money that you're making today. What you made 2 years ago or 3 years ago really doesn't matter related to your payment. But in agency lending, it matters a whole bunch.
Okay. And actually, you know what? This spurs, you say common sense lending. To me, this sounds like out of the box lending.
Yes.
Right? So, I mean, you have all these creative solutions. And I like that you brought up, the teacher scenario, because I'm thinking your main client base is probably self-employed individuals. So even real estate agents were commission based. So, sometimes it does get very tricky to be able to qualify for a loan.
see it all day long. I mean, we get we do deep dives into income to find income. Unlike agency lenders, we're always looking for a way to make a loan happen. We're not looking to fill in the boxes. So I tell people on a regular basis, the brokers that we deal with, that our guideline book, we have to have a guideline book, but our guideline book is written in jello. There's an exception or some way of wiggling around to find the right borrower, the right loan package, and get them into that property. And then if there is a tangible reason why they can't be in agency, they can, over the next year or 2 years, restructure some of the things that they do, see that maybe some of the write-offs that they're taking in their tax returns aren't necessarily that big of a benefit to them, that they redo their tax returns for the next year or re-amend their tax returns to qualify into an agency product, the lowest rates possible, and then refi out of it, but you are being able to get the quality inventory that's out there. Inventories are coming up in the market, but quality inventory is where it gets tough. So when you find that house that you really want, are you ready to be able to put a non-contingent offer on it immediately because somebody else will? And then you'll be stuck with the properties that you might not necessarily want.
Right, and that's why one of our, it's funny, Jay said it in front of our meeting. Two things I love is you say the guidelines are written in jello. One of my managers literally wrote that down and put it on our internal matrix as the note for your company. It says guidelines are jello, which means common sense. Where you're gonna, and you guys will even get on the phone with the clients. You'll talk things over. Hey, explain to me how you make this money. What do you do here? That's not something you can do in the Fannie Mae, FHA, and VA and conventional world. You mentioned clicking a box. That's all government lending is. It's clicking the box. You click enough boxes, they hand you money for your house. You don't click the boxes, you don't get the money. With you guys, you have jello boxes.
And we generally, as a rule, want to lend people money more than they want to borrow the money, which in agency, you definitely don't have that. We're always looking at every opportunity that comes our way. And we're talking, somewhere in the area of $500 million a month. We're looking to capture every one of those opportunities. As loans come in, and how our compensation plan works with our account executives, they are actually bonused on the ability to close the highest percentage of loans possible. So we're not throw the loan against the wall to see if it sticks kind of lender. Where let's throw it against the wall and make it happen and find a way to get this borrower. A lot of the scenarios that come my way are presented one way, and by the time we get done, we've done a 180-degree turn to actually find the loan inside the original presentation.
So you probably, I'm sure this is going through your mind here, but actually, I'm going to mention this first, and then I'm going to ask the question. One of the most exciting things that you said in our presentation was that unlike government and conventional loans, where we have to use the lower credit score of the two buying individuals. So you got husband and wife, one's got a 650, the other has a 750. You got to use the 650 when you're qualifying them on government and conventional loans. You always the lower the person. You said that you actually get to use the primary wage earner's credit score. So if the husband is the primary wage earner maybe, and he's got a 750 and the wife has a 650, we're using 750. Is that right?
Absolutely. We just actually closed a loan. Now this was a little bit tricky, but a non-occupant co-borrower. So we had a lady that just graduated from nursing school. So she was in her first contract, low income, couldn't afford her property. So her father came in and was not going to be a co-borrower. Well, was going to be a co-borrower, but a non-occupying co-borrower. So his credit score was much higher than hers. I think she was a 705 and he was around the 790, 800. He made more money than his daughter. So he ended up in first position. So his daughter, even though she was going to be making the payments, he was just the security behind it. She got the benefit of his credit score, the lowest rate possible and the highest loan to value possible, being a brand new graduated nurse by bringing dad into it.
That's awesome. That is. Yeah. So are you thinking something I'm thinking?
I think that's incredible. And I love it when people do have creative solutions. We want to get people into properties, people want to live in a home that they own.
Yep.
So, and it's not fun when you're being told, nope, you can't get, FHA, conventional, you just, you're stuck.
Yeah,
Wait around for 2 years. So then, they go see you and you tell them, you know what? Nope. Tell us your scenario. And you have a product for them where they can get that loan, get the house that they fell in love with. I love it.
That's it. So here's the question I'm asking when we get back from the break. What in the hell is the catch? There's got to be a catch to this. There has to be something that we have to give up. But we're going to answer that question when we get back, and I'll tell you how you find all these programs. 813mortgage.com, Frank the Bank. We'll be back in just a minute. Thank you, James. All right, last segment. This is growing great. This is perfect. So I think how we should frame what's the catch is, I mean, you can make it in a positive frame. You can say it, you say whatever you want, but the catch is not going to be the catch that you think it's going to be. Oh, okay, then I'll shut up. Yeah. Most people think that the catch is going to be 13% interest rate. Right. Our interest rates are a hair higher than agency, and in some cases, second homes and investment properties. Yep. We're lower. Yep. The cost to lend is lower. So what are you going to say the catch? LTV? Like a slight difference? Maybe you need to put a little bit more money down or something? The real catch is that we're going to ask for a little bit more. There you go. Because we're not using a computer to say yes or no. We're using eyes and a brain. I love it. So there's going to be a little bit more documentation in some loans, but it's a pathway to get into the house. Yeah, and you want to ask any questions after that? You got anything come to mind?
Well, I know DSCR has been a term that's been floating around.
There you go.
So, I mean, if we have time and you want to explain.
Yeah, we'll do the catch and then ask about that. Be like, do you guys do those DSCR things I hear about? Yeah. They kill it on those. And you can chime in. You don't have to be quiet. Yeah, chime in. So this one is an 8-minute segment. We'll get the intro real quick, and then I'll give you guys I'll give you like a 4 and a 3 and stuff, so we know if there's anything you want to make sure you say, how much time you got left.
Now we're back with some serious real estate and business talk with 3 of Tampa Bay's top experts. Your host of the Business Happy Hour, Frank the Bank Cotto, Rosa Fahidi, and Senia Akishna.
Hey, Tampa Bay, welcome back to the Business Happy Hour. Man, Senia and I have a good show today for you. We have been talking about common sense lending with LendSure. By the way, guys, if you're wondering, you're hearing about all these products and you're wondering, well, how do I get in touch with LendSure? You don't. You call Lincoln Lending Group is what you do. You go to contactfrankthebank.com or therealdealtampa.com. You talk to Senia, she'll get you over to me. And remember, guys, we offer all products. So if we do get your application, we're going to try to take you in the government conventional route. And if we can't, we have the best option right here with LendSure. And if you're an originator out there and you're like, God, I need that lender. How do I get that lender? The same thing. You go to contactfrankthebank.com. You call me. You can come work for us, and you can work right here with Jay and Kyle at LendSure. Or to be honest, you could probably sign your company up with them. But I'd much rather you come work for me. So contactfrankthebank.com, or you can go figure out how to find LendSure on your own. All right. Jay. What's the catch? You just told us all this amazing stuff you can do. I mean, there's got to be a catch. You can't be doing everything just like Fannie Mae and just making it that much easier, right?
Well, when I'm talking to people, at a cocktail party or, at a dinner engagement about what we do, they're always thinking that the rate is going to be very high. Our rates in the current market are just a click above what the agency lending is, but none of our loans also carry mortgage insurance.
Yeah, PMI.
So when you take the PMI out, a lot of times the payments get back into line and be even. Now, also, back when the big crash happened in 2008 and the government came in to save Fannie and Freddie, it was supposed to be a short-term venture, which has turned into a multi-decade venture. Well, now they're trying to break that conservatorship again, and one of that is the cleanliness of the books. So in order for agency lending to slow down some lending in different sectors, they increase fees and increase costs. So in a lot of times on an investment property or a second home in the non-QM sector, you can end up being in a better financial position by leaving the agency market. We also have a very, very popular program. It's probably our most robust program right now is buy now, sell later, which we call the Boost program, which is a bridge loan. It's a modified bridge loan. The word bridge is used in a lot of places in lending, but we'll actually give you a loan on your departure property, extracting the equity out of that property, eliminating the debt from that property, freeing up all of your assets and freeing up all of your income to immediately buy your new property and then dispatch the departure property in the next year. that property has gone absolutely crazy because it turns you in from listing your house today to actually shopping tomorrow and being able to really tap into the quality inventory on a non-contingent closable deal, and then the dispatch of the former property with no payment attached to it, and then that goes away and you pull the rest of the equity out at that point.
I did see Senia perk up as soon as you said that.
No,
so
I love that. And I mean, that is a solution that I think a lot of people could use right now.
Yeah, absolutely. They still want to sell their property, but this is an option for them to actually buy the new house first using the equity in the one you're selling. You even allow them to pay off debts and do other things with this money. So it's very, very creative. Again,
we
common
have
sense.
gotten very creative. Just recently, we closed one where we did a bridge loan. We pulled equity for down payment, and we pulled equity, put it in the bank, and used that as an asset qualifier within a loan. So we created income by giving them a no payment loan.
Yeah. It's
which
crazy.
is just amazing.
They don't count the payment against them or on the house that they're selling. And so they put money in the bank and then divided it out and created income for it.
No, that's awesome. I'm
Right.
just thinking, hey, go buy your next house, tomorrow.
Right.
And then when the market really wakes up, it's going to be even easier for you to sell your current home.
It-
So
100%. Oh, exactly. Then it'll be a better market. Listen, the catch, guys, is just you got to give Jay a little bit more. You got to, if you're putting 3% down conventional, you're probably going to need 10% down to go into non-QM. If you're, putting down an investment, you guys are honestly right there when it comes to investment in second home. You're no different really than Fannie Mae when you take into consideration that PMI that you talked about. You try to put 15% down on a investment property, Fannie Mae wise, the PMI is ridiculous. The rate is ridiculous. I will guarantee we'll get a lower rate. How do you get all of these benefits? ContactFrankTheBank.com. That's all you got to go. ContactFrankTheBank.com. I'll get in touch with Jay and Kyle, and we'll get you in front of them. I know you had another question about a product, right?
Well, because, the other term we've been hearing a lot of is DSCR.
Right.
So that's a non-QM product, right?
Yeah, I think so.
Yeah,
DSCR generally
what does it mean?
it's considered a debt service loan. So all of your debt, your private debt or even commercial debt, completely goes away, and you're only looking at qualification of a credit score and the payment on your new property versus the rent that you're going to be bringing in on that property.
So what case would somebody use it? Like an investor? So if
They're
somebody
all
wants
investor.
to. Okay.
They're all investor. Any primary residence does have to be income qualified under federal regulation.
This is for hey, I want to get a multifamily
Yeah.
going,
Or
start my
just an
investment
investment
portfolio. Okay.
But we do these with standard annualized rent. We do a short-term rent. We do a condotels.
Condo
which are
hotels.
very popular product in
You
today's
said
market.
Airbnbs?
Airbnb, short-term rental, Airbnb.
Oh, yeah.
And we can pull the rent rolls on a new property in a lot of different sources through the appraisal or through AirDNA. There's different services out there that we can generate approved numbers.
I love it. Kyle, what do you have to throw in? We got about a minute left.
I mean, the biggest thing that takeaway from this is that in common life, people don't want to ask questions.
Right.
They want to assume, they want to be the knowledge expert and stuff. And all of us in this room right now, we all know that each day we're learning something new. I'm not an expert on everything in the non-QM world. You're not the, don't know everything about HELOCs and stuff like that. So the biggest thing is always to ask the question. Don't assume that just because your situation is a no, ask away, and the worst answer could be a no or it could be a yes, and then you're on the pathway of that next property.
Yeah, exactly.
We really specialize in turning chicken poop into chicken salad.
And if you don't ask, you're not going to get the yes. So you have to ask. I love that.
And it's our job to write the story. We're pretty much an author.
Yes.
Give us the information, let us put it on paper and find a pathway to that success story.
I love it. You guys have really summed it up. Your guidelines are jello. You're real people. You will talk to people. You will figure out scenarios. You will work with my team and with Senia and to figure things out. So you got to go to us first. You got to go to therealdealtampa.com to talk to Senia about finding the house. And you got to go to contactfrankthebank.com if you want to get your hands on these LendSure products. You can talk to me as a new originator, an existing originator, or a client, or even an agent. We are happy to do it. Guys, thank you so much for coming on the show. Your first time on radio, and you killed it. It is
Yes,
awesome.
thank you very much. This was
problem.
very
Thanks for having us.
Absolutely. And you guys have a wonderful Christmas. Guys, remember, LendSure and Lincoln Lending are here to say yes, not to say no. Common Sense Lending. Check us out. Contact frankthebank.com. And for the best real estate team, Mahar and Associates, therealdealtampa.com. See you guys next week.
We forgot to turn the camera before.
See you then. All right, Instagrammers, thank you for checking us out. We will see